Now, this is coming directly from a real conversation I had with someone not that long ago who had told me that they had a banking style whole life insurance policy. I won't tell you the names of the insurance agents or the groups of people, but let's just say you've probably heard of them. They're all over the interwebs and that sort of thing. And they're promoting infinite slash cash flow slash family wealth banking style whole life insurance. I mean, again, there's so many nicknames out there for this, and so many insurance agents that would love to sell you a policy that may or may not be properly structured. It's not unlike getting onto an airplane. Airplanes are incredibly simple to fly in. You just get in, buckle in, and off you go. However, there's a ton of engineering that goes into the mechanics of that airplane. You want to make sure that the people who've built that thing knew what they were doing, and that you've got a competent pilot who can make sure to land, fly, get you to your destination, all without a lot of turbulence along the way. This is very similar to what I'm going to be describing to you today. So this gentleman was, very happy, so he said, with his existing whole life insurance policy. And what's not to like? He had a mutually owned life insurance company. Check. It was whole life insurance. Check, check. It offered paid up additions in the premium. Again, check marks all around. And the policy was significant in terms of its cash accumulation. By the time I spoke with him, he was in midway through the 9th year of his policy, and he had been truly maximizing the funding of that policy, overfunding it beyond what his planned premium was. We'll get into the details here in just a minute. And so overall, he thought this thing was built correctly. And so as we got into the details, I think he was shocked by what he saw, and I know you will be too. The bottom line is he was losing out on hundreds of thousands of dollars, and the policy was going to train wreck into becoming a taxable endowment in just a few short years. So with that out of the way, without burying that lead, let me get right to the specifics of this guy's situation. Again, I'll take his name and details out of it, but I think it's worth looking at because so many people bring to me their existing insurance or hey, their buddy down the street could design a policy for them, so they thought they'd go ahead and work with their buddy. Guys, I'm telling you, if your buddy was an airplane pilot or said he was, and he got a weekend seminar class on the topic of flying airplanes, would you feel comfortable getting onto his little prop plane, right, to fly over your city? Not me. So let's get into some of the specifics on what was going on with his policy. And maybe if I can explain this to you, you can avoid a similar fate that he was stuck in. All right, so we're going to be really covering the difference between direct recognition and non-direct recognition policy loans. Now, again, some people on the interweb say it doesn't matter, no big deal. You should just get a direct, whichever one gives you the bigger cash value, right? I disagree. I think if we're going to use the cash value for any reason over your entire lifetime, then it's imperative that you use what's known as non-direct recognition. This is what we implore folks to use in the Bank on Yourself ecosystem. It's part of the long laundry list of characteristics and attributes we look for when designing the policies properly. So there are problems, significant problems with direct recognition policy loans. Let's get into some of the specifics of this exact case. So the gentleman I was speaking with, when he was 33 years old, he opened up a policy from, again, a one of the top half a dozen mutually owned life insurance companies out there. And it was, a mutually owned company. It did offer direct recognition. However, the specifics on this particular policy was that they would still pay some dividends, and I'll show that in just a minute. It was a partial dividend on any account value that was borrowed against. So for those that are less than familiar, just let me give you a quick scenario on what's the big deal. So just to clarify for everyone who may not be as familiar with this as us nerds like myself, direct recognition life insurance policy loans work this way. Your cash value grows just fine without the loans. It just continues to grow with guarantees, also possibly dividends. That's exactly like a Bank on Yourself policy. The difference comes when you borrow against a direct recognition cash value policy. When you have a loan against a policy that's directly recognizing that you took that loan, the dividends will be reduced or completely eliminated down to $0, meaning you're no longer earning as much or any cash value growth with dividends on any account balance that you've borrowed against. So, for example, if you have a $100,000 cash value and you've borrowed $80,000 for any reason, with direct recognition, you'll only be receiving full dividend growth on the remaining $20,000. But with a true bank on yourself design policy, the kind I typically recommend, then the cash value will continue to earn the full dividend on the entire cash value, the full $100,000, as if you had never touched a dime of the money. To me, this is as if your money's doing two things at once.